Physical Gold Fund presents Global Perspectives with Alex Stanczyk and invited guests. We'll be exploring international markets and the complex forces that drive them, including geopolitics, economics, and the global monetary system. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the first podcast with Alex Stanczyk in the series we're calling Global Perspectives. Alex Stanczyk is the Managing Director of Physical Gold Fund. Alex is an expert in the physical gold industry, dealing with the logistics chain from refinery to secure transport and vaulting, and he's lectured globally to investor, institutional, and government audiences on the role of gold both in the international monetary system and in investment portfolios. Hello, Alex.
Hello, John. Great to be here. This is going to be a wonderful conversation today with someone whom I'm a big fan of personally.
I'm sure it is. And our guest indeed today is Brent Johnson. He's the CEO and portfolio manager at Santiago Capital, a hedge fund that focuses primarily on bullion and other metals-related investments. Brent has been creating and managing wealth management strategies for high net worth clients since the 1990s. Early in his career, he was a financial auditor for Philip Morris Management Company, and he went on to serve private clients for Credit Suisse. Brent recognized early on the need for a robust precious metals solution for his clients, and that's what prompted him to launch Santiago Capital. Since then, he's attracted a growing following as an expert on gold. Now in his spare time, Brent devotes himself to educating the public on financial and monetary issues, and his work is often featured throughout the blogosphere, including Zero Hedge. Welcome, Brent.
Hi guys, thanks for having me. It's great to be with you today.
And now, Alex, over to you.
Okay, thanks a lot. So let me start out by saying, Brent, it's really great to have you on. One of the things that I find really interesting about you is that you don't really follow the crowd. There's a lot of different analysts in the space, and interestingly enough, and you're probably already well familiar with this, sort of the common theme or the common thing that you see amongst analysts in the sectors is that they all often parrot each other. And I find it kind of curious how that happens, and it isn't so often that you run across someone who's got some original thinking and some original content, and you definitely sort of fit that mold, or you're sort of the person who, I shouldn't even call it a mold, you've broken the mold, who really kind of looks at the whole situation in your own sort of way. So looking forward to what you have to say on a lot of these different levels. If you don't mind, Brent, let's talk a little bit about your latest presentation. Is called Don Juan. Can you give us like a really quick summary of Don Juan and what it means to you?
Sure. Yeah, and thanks for the nice words you said. By the way, I'm excited to be able to come in and talk to you, and I've been a fan of your work you do as well. So this is a great opportunity. As it relates to Don Juan, it's really a play on two of the biggest forces I see in the world today, and it's not just market forces, it's political forces and it's social forces, and that's Donald Trump, the Don, and then China and the Yuan. So rather than Don Juan, I kind of titled my latest presentation Don Yuan, because I really do see those as being the two primary forces right now. And it's kind of a funny play on words, but it's actually a pretty serious topic when you really get down to it. And it's a very divisive topic, but it's an important one. So that's a long way of explaining the Don Juan title, I guess.
I understand. Let's dig a little deeper sort of into some technical areas that you had mentioned in your other series, Step into Liquid. And one of the things that you talked a great deal about was stock and flow of the money supply. And a lot of people are familiar with this concept of stock and flow, but they may not really understand why the flow part of the stock and flow is so essential and why it plays such a big deal in sort of your framework of looking at the world. Can you talk to us about that, about why flow is so essential?
Yeah, absolutely we'll do that, because it's really kind of the key to everything. And it's funny because I kind of learned this stuff in college, but I probably just learned it long enough to memorize it, to pass whatever test I was taking, and never really thought of the real world implications of it. And then, 10, 15 years ago, I started looking at it closer, and 10 years ago when we started getting into 2007, 2008 timeframe, I took a really hard look at it, and that's when it really hit me. So the stock and the flow really goes back to a debt-based monetary system where money, for lack of a better word, is loaned into existence. And the way that our monetary system is designed has a severe design flaw in it. And you can argue whether or not it was done on purpose or whether it was done on accident. We could probably do a whole hour just on that. But regardless, the flaw is there.
Yes.
And the flaw is that in a debt-based monetary system where money gets loaned into existence, all loans have interest attached to it. So if you loan money into existence, then at the end of the year, you need more money to pay the interest than actually exists. So either the existing money in the system has to be circulating, or the flow, for lack of a better word, has to be flowing at a fast enough rate where that money can change hands and satisfy everybody's interest payment. If that flow is not flowing at a high enough rate to where the interest gets paid, then loans go into default, and because it's like a daisy chain, it starts cascading all the way back to the base money from which that money was loaned into existence to begin with. You know, you look back at all the central banks are like this. They're all kind of based on the same design, but you know, for this argument, let's just look at the United States. The monetary base is around $4 trillion, about $2.5 trillion, or actually it's about $2 trillion. $2 to $2.5 trillion is reserves at the Fed, which isn't flowing. That money just sits there as a reserve, the bank's reserves. Then there's about $1.5 million of physical currency, which actually, so that's money that actually exists. That's the base money. All the other money is basically digital money, ones and zeros that are loaned into existence, and it shows up on a ledger somewhere that says you have this money, and et cetera, et cetera. And so, you know, if you look at the total banking system, the banking system has, again, it depends on how you measure it, but let's just say $16 trillion of banking assets. So if $4 trillion is base money, then that means there's $12 trillion of money loaned into existence, and you know, some other assets, et cetera, et cetera. So anywhere from 10 to 12 trillion is loaned into existence. So there's interest attached with that 10 to 12 trillion. And you know, if that's right, so if that money isn't circulating, those loans go into default, and you can think of it similarly like a collateral account on a brokerage account. If you buy on margin and whatever you buy doesn't go up, then the equity gets eroded and you have to resupply the collateral, or else the whole account fails. It's very similar. If GDP and money velocity is not high enough, that there's not enough transactions going on to satisfy all those interest payments, well, then the Fed has to come in and plug the hole and, you know, add money back to the collateral, which is the base money. And so, and so that's really the stock and the flow. And if you look at the velocity of money, it really started in the late 90s, probably around, you know, this would be a great question for, you know, Jim Rickards, who I know you're very close with. You know, it all started around the 98 crisis, when long-term capital management, the Russian debt crisis, and the Asian currency crisis. You can look at the velocity of money, and going back there, it's just been on a downward slope ever since then. Now, there's been a couple times where it, you know, turned back up for a year or so, but then, you know, just turned right back down, and we've been in this downward motion for 15 years now, 16 years now, almost 20 years now. And you can go back and you can look at the reserves at the Fed and the base money, and it's ramped up since then. And there's a direct correlation. If money is not moving, then they have to continually fill up the collateral, and that's the essence of the stock and flow. That's the essence of the flaw in our monetary system. The other part of it is that if the money is circulating and there's no problems, the interest attached to it, even if it's just 1% a year, it becomes an exponential system. It doesn't matter. You can start with number one. If you take 1 times 1.01 year after year after year after year, it will eventually go exponential. It'll turn straight up, and it'll, you know, and then you get the inevitable blow off top that ends with a magnificent crash, right?
That's the hockey stick on the chart, right?
Right. So, exactly. So it doesn't really matter whether or not the money is flowing or whether the money is not flowing. That design flaw of the money loaned into existence is a catastrophic flaw, and it's bound to fail. It's just a matter of time.
And we're not talking about philosophy here. This isn't about whether this monetary system or that monetary system is a better thing, or a gold standard is a good thing or a bad thing, or whether Keynesian is a good thing or a bad thing. We're talking about math right now.
You know, if you believe in math, buy gold, because, you know, our monetary system, mathematically, certainty will fail. Right? That shouldn't really be a provocative statement. It's just math. You can argue with math if you want to, but you're going to lose.
You're going to lose. Absolutely. I totally agree. And that's something that I think a lot of people don't realize about our monetary system. I think there's a lot of people caught up in this argument about it, whether Keynesianism is a good thing,
right,
or whether the gold standard is the way to go, or whatever, all those kind of things. And you know, I'm not going to argue that one way or another right now, but I mean, if you just think about the math, that's really critical. People need to understand that it's going to change. It's only a matter of time. All right, so
exactly.
Let's move on a little bit and talk about regulation. And
sure,
that's been kind of a big topic for the current incoming Trump administration, and I'm sure for business owners for decades now, or at least going on a decade and probably longer. The amount of regulatory creep that's been occurring has been getting more and more intrusive, and really not just in the United States, but globally. I mean, from a global perspective, our fund operates globally. We've done business globally for a real long time, and we've seen the regulatory creep effect there and how that's affecting things. What do you think is going to happen as this creep continues to impact the banking system, and like, how can this be a big problem?
Yeah, well, boy, that's a big topic. I mean, there's a lot of different ways it can be a big problem. There's probably one area that I can focus on that kind of will help explain it in a somewhat simple manner. You know, if you think back after all the problems that happened in, you know, let's call it between 2006 and 2010, right? The run-up in the real estate bubble, the explosion of the real estate bubble, and then all the ancillary negative effects that happened for the couple of years after the bubble popped, right? You know, the banks did a number of things wrong, right? And we can just leave it at that. We don't have to get into all that detail right now, but they did a number of things wrong. Yeah. The public bailed them out, perhaps rightly so. The government said, well, we got to go in and do something to make sure this doesn't happen again, right? And like all good government programs, they maybe start off with good intentions, but they end up with a really bad result. And one example is that, you know, the Basel III Dodd-Frank requirements that are now imposed on the banks. It makes sense. The whole goal of the Basel III comes from Basel, Switzerland, where the Bureau of International Settlements sits. That's essentially the central bank's central bank. So they are trying on a global coordinated basis to establish a framework through which all these other central banks and governments and monetary authorities can craft a global solution to keep this from ever happening again, right? And again, starts off with good intentions. But, you know, the one area that we can use it as an example is they thought, well, we need to make sure that the banks are adequately capitalized so that if we ever have another downturn, they don't go through this big liquidity event where their, you know, capital evaporates and the public has to bail them out. In theory, that sounds pretty good. The problem is getting all these different countries to agree on the same thing, and then of course politics comes into it. They do things like they say you can hold these different securities on your balance sheet, but they are all going to have different ratings. Well, of course, they give their own debt, the country's debt, a zero risk weighting, right? You can buy a Greek bond, a Portuguese bond, a U.S. bond, or a Chinese bond, and they're essentially all given a zero risk weighting, which on the face of it is ridiculous, right? But that's the rule. So the intention is good. That's just one example of where now banks can hold risky assets on their balance sheet, and it says they don't have any risk at all, when in fact they're carrying a lot of risk. Especially when you look back and, you know, I don't know if there's ever been a country in history that ever paid off its debt without inflating it away, right? So the fact that you take the one entity, which is a government, which has never made good on its debt, and you give it a zero risk weighting is, you know, in my opinion, it's a bit ridiculous. But that's just one example. So, you know, let's take a little bit further. So in the U.S., you know, the framework under the U.S. under which, you know, kind of bubbles up to the Basel III Accord is the Dodd-Frank. And one area in particular that they took a look at was money market funds. And, you know, for several years they have said by October of 2016, money market funds will no longer be able, they will have to mark their book to market. Basically what that means is for a long time, you know, these money market funds were created as a way to provide short-term financing for banks and other big corporations. It's almost like cash. So, you know, people that are invested in it, they kind of assume that it's cash, and so it always just keeps a par value. So if you put $1 in, it shows $1 on your statement, right? But in actuality, these are bonds underlying these money market funds. Now, very short-term bonds, but they're bonds, and there is risk. And occasionally, especially like in 2008, there were some failures, and some of these money market funds broke the buck, so to speak. So they actually printed 99 or 98 rather than 100 cents on the the dollar. Well, in their infinite wisdom, the government said we can't have that anymore. We can't, we'll give you a few years to get on board, but by October 2016, you're going to have to market these funds to market. Well, that was the case for prime funds, which are corporate-backed funds, but not government funds, right? The government doesn't have to mark their books to market because, we're the government, we're never going to default, and we don't have any risk. So what you saw as a natural progression is people who didn't want to take that risk, they left prime funds, and they moved all their money into government funds. And so there's been a big sea change from prime funds to government funds, which perhaps on one level that's good, but the problem is now you've got even more people huddled and concentrated in one area, again, government funds, which in my opinion have, in many ways, maybe more risk than a AAA rated corporate bond does, right? So that's one example. Not only that, but a lot of the banks that they're trying to protect against, they used to get their short-term funding from these money market prime funds. Now that those money market prime funds are gone, they don't have that competition. They don't have that, so there's no competition between prime funds and prime funds anymore. So, that they've lost one area of financing, so the cost of financing has gone up. So you can look at things like LIBOR. You look at LIBOR between July of last year and October of last year, and it almost doubled. And it's basically because a big part of it was because of this movement in the money market fund. So now you've got a higher concentration of funds, a higher cost of funds, and a lot of people concentrated in an area that perhaps has more risk than they otherwise think it has. So that's just one example of how regulatory good intentions end up being long-term bad solutions. That's probably the best, easiest way I can explain it.
Thanks, Brent. It's John here. So just talking of concentration, do you have any observations about the whole phenomenon of too big to fail, of the largest banks simply getting larger and larger, and in that respect becoming kind of unassailable?
Yeah, I mean, it's really true. I mean, and you've seen these banks get bigger and bigger, right? And I don't have the market caps right in front of me, but they're much bigger now than they were in 2008. If you total up all the fines that the banks have paid between 2008 and 2016, it's something like $300 billion. Now, name me another industry where the bank, where that industry can pay $300 billion in fines, still be in business, and still have their profits going higher, right? Another part of it is you don't pay $300 billion in fines if you're treating your customers well, right? So what other industry can do that to their customers, stay in business, and grow? It's kind of ridiculous, crazy, right? Yeah. I mean, it's, on the face of it, it's just absurd. Where this is another example where this is becoming a problem is as these banks have gotten bigger, as regulations have gotten more intense and more severe, the part of the reason the big banks have gotten bigger is they're the only ones that can afford to hire the lawyers to comply with all these rules and regulations. And so maybe these smaller community banks or regional banks that didn't have anything to do with the problems that caused 2008 and 2009 are the victims of it because they've now had to implement new regulations and procedures, and they've had to hire 10 lawyers instead of one lawyer, et cetera, et cetera. And they basically just can't compete against the big guys, so they either go out of business or they sell to the big guys, and the big guys just get bigger again. And not only that, then you've got a big national bank perhaps, representing a small, manufacturing facility in Dubuque, Iowa. You know what I mean? And the big national bank has no idea what goes on in Dubuque, Iowa. So maybe they can't even make that good of a decision of whether, that company deserves better credit or worse credit or a loan or, you've gone away from community banks serving, small businesses to these big mega banks trying to write, rules and regulations that apply, black and white to everybody when it's really a gray world. So I see big problems with all these regulations. I'm a free market guy. I think the free market solves all the problems. And people say, well, yeah, but if you don't have regulations, then, all these banks would have gotten away with murder. Well, no, they wouldn't have. They would have been bankrupt. They would have been gone, and the problem would have been solved. So cute way of looking at it, but I still believe in capitalism.
And you know what? This is an area, Brent, where you and I think we largely agree. And the problem, as you mentioned it, as you explained it, even feeds on itself because it's sort of like raising the cost of entry into the market by creating all these regulations so smaller businesses really can't compete. And the problem with that, obviously, is if there's no competition, then there's nothing that's going to be keeping these guys honest if they can get away with it, right? So,
Right.
that's a big deal. If we can circle back around to our earlier topic for just a minute, I think that it might be helpful for our listeners to know a little bit more about velocity of money and what it means. So not everybody understands that. You and I, in the industry that we're in, we get that. We understand what that means. But, as far as velocity of money, last chart I looked at from the Fed, the current velocity of money it hasn't been this bad really since probably maybe 1971 or 72. It's absolutely horrible. I think sometimes people wonder, well, since the last global financial crisis, we've printed up trillions of dollars. Those dollars have been injected into the economy, but we aren't really seeing inflation. And see, all the Keynesians are coming out going, look, money creation doesn't create inflation after all.
Right.
But what the part they're leaving out is the whole velocity part. So what does that mean? I mean, what happened there? We had all this trillions of dollars injected into the system, but we really haven't seen much inflation. What's going on with that?
So, there will be people out there that will say, what are you talking about? We've got incredible inflation. House prices have doubled. The stock market's tripled. When I go and I buy, my Thanksgiving dinner, it costs me $150 rather than $89, right? So I think there has been inflation, but it's actually been more, while there has been some consumer price inflation, in general it's been more asset price inflation than consumer price inflation, right? And a big part of that is again, part of the way the monetary system is designed. The way it's designed is the central banks give the banks the money, then the banks give the money to Main Street, right? There's not a system where it goes from the central bank to Main Street. And the mechanism by which it goes to Main Street is loans, that money creation that we talked about earlier. Well, if you look at if you look at all the QE that we've done, the quantitative easing, the bailout packages, et cetera, stimulus packages, however you want to define them, it was done as a way where, the central banks bought assets from the banks, and in exchange for taking those assets from the banks, they gave the banks cash. Well, the banks did not then loan that out into the market at the rate that the central banks were hoping that they would. Now, you can make a big argument. Did they not loan them out because they didn't want to loan it out, because they wanted to keep it for themselves and collect interest on it? Because they actually get paid by the central bank just to hold on to it. Or was there no demand? Was the consumer so tapped out that there was no demand for the loans? And I think that could probably be a whole other hour topic on itself as well. But regardless of whatever the reason is, that money did not flow to Main Street. And that is when I was talking about earlier, as velocity fell, the reserves of the banks at the Fed increased. I mean, it's almost a one-for-one correlation. Now, a lot of people will say, that's not, and that's why we haven't had inflation, and you shouldn't worry about QE because it's not inflationary, because it's just sitting at the banks. Well, technically, that's correct, but it's very disingenuous, in my opinion, because the reserves at the Fed is what the banks use as collateral to make new loans. So even though they haven't made new loans yet, they've got $2 trillion in reserves now that they didn't have 10 years ago. And on a 10-to-1 reserve to loan ratio, they need to keep 1 unit of reserves for every 10 they loan out. $2 trillion of reserves could actually become $20 trillion in new money. 10 years ago, the monetary base was $800 billion. Now it's $4 billion. And on reserves of $2 trillion, they could loan another $20 trillion into existence. The total banking system assets right now are around 15 or 16 trillion. So they could essentially double the size of the banking system on those reserves that have been given to them in the last 10 years. So if and when that happens, that would be highly inflationary. So it's kind of like a dam being built, right? And so, we have all this liquidity flowing towards Main Street, but the banks built up a dam. And all that flow, all that money from the Fed just kept building up behind this dam, and it kept getting bigger and bigger. And now there's a big lake there. That's the reserve, right? It's become this huge lake. Well, if that dam ever breaks, or if they ever open the levees on that dam and start loading it out, well, that can lead to even higher pressure of that flow coming out, right? And that can lead to even higher inflation if and when it happens. So now I can't tell you for sure it's going to happen. I actually think it is going to start to happen for reasons that we can get into in a little bit, but those reserves that have been built up that everybody says, see, these aren't inflationary. They're the tender for the inflationary fire that can come later.
I totally agree. It's interesting because when there's no velocity, in other words, people aren't spending money, loans aren't being made, then that creates what you were talking about, that big sucking sound in the flow of money. And they have to continually add more dollars to the system to make up for that sucking sound, which is really only making this lake bigger. So
bigger. No, exactly. And so you've really touched on the key to everything. The key to everything is the velocity of money. It really is. If the velocity of money picks up, then you're going to have inflation, and maybe this flawed system can go on a little bit longer. But if they cannot get the inflation if they cannot get the velocity to pick up, then inflation's not going to pick up, growth is not going to pick up, and we're going to be back to this deflationary debt spiral.
You've been listening to part 1 of the latest podcast from Global Perspectives with Alex Stanczyk, presented by Physical Gold Fund.